Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Republican leaders in the House struggle to find the final votes for President Trump's tax bill. Voting is still underway in Washington. US payrolls data is due later today. UK Prime Minister Keir Starmer belatedly backs his Chancellor after her tearful appearance in Parliament sparks a gilt sell-off. We will bring you the gilt market open in an hour's time. Plus, on trade, Washington announces a trade deal with Vietnam, while Siemens says it's received notice that some US chip curb restrictions to China have been lifted.
In the meantime, a quick check on these markets. Lots to digest here, and yet the markets are in the green. Perhaps a little bit of recovery from yesterday's session, especially when it comes to the FTSE 100. Higher by 0.3%. We'll see if that sustains into that gilt market open at 8 o'clock, as Anna was saying. Also, keep an eye on the currency. 136, some weakness, I should say, in the pound off yesterday's sell-off you saw in the bond market. Does it continue today? 136 on cable. And, of course, we are looking ahead to payrolls. 425 on the 10-year yield. Does that drop further as well? The countdown to the opening trade starts right now.
Thursday morning, good morning. The last day of the week, particularly if you're an American disposition, if you're of an American disposition. But we've got an awful lot to get through, don't we? We've still got to figure out what is happening with the US labour market. Payrolls are coming a little bit later on. And do we have a big, beautiful bill? Will we get a big, beautiful bill before the 4th of July? We are watching Washington with a great deal of interest, Chrissy.
Not this American. This American's working tomorrow, despite the Independence Day story. But it's a good thing, though, because, in fact, we may not actually get a resolution when it comes to this tax bill by the 4th of July, as Donald Trump was hoping. We are still seeing voting happening right now in Congress, as you said. We are 5 votes short. So there's some flipping that needs to happen. I think it's really interesting. I did some digging into who the actual 5 people were in terms of the holdouts. They're really targeted around health care spending. And I thought that was a key piece of it, because when you think of Republicans in the states, healthcare spending isn't the first thing that comes to mind. In fact, famously, it's the opposite.
So this is on the moderate side rather than on the fiscal hawk side that is getting pushed back in the House.
Exactly. Senators or congressmen that are exposed to more rural communities that don't have as much access to kind of big city healthcare. And that seems to be more of the issue in the House, whereas in the Senate, the concern was more of the deficit.
We're not even at the bill yet. We're not even voting on the bill yet, are we? We're still in the procedural process of allowing it to get to the floor. And we've got 5 holdouts. I think they can have 4. And there seems to be some ambiguity around that as to whether or not they can actually make this work. So they've got 5, which feels like a big number relative to kind of what they need to get this thing across the line. Trump did a lot of arm twisting yesterday, and we're still here this morning without a big, beautiful bill.
And we haven't seen this really captivate the long end of bond markets in a way that we might have thought it would. I suppose you were referencing the Senate vote, which was all about fiscal sort of probity, and this has been about something else. This has been about the more moderate end. Thinking about how markets respond, we are working our way towards the non-farm payrolls number later on today. 106,000 is what we're looking for. And I was doing a bit of reading around what it would take on the unemployment rate for the market to start thinking, oh, the Fed is going to cut soon. And BMO did a survey, and they said 4.5% is the number. And the expectation is we don't get to 4.5% today. We get to something like 4.3%. Up from 4.2. So we are expecting unemployment to go higher, but maybe not enough to trigger the Fed thinking about rate cuts.
So here's the thing. Let's assume you get 0 immigration into the United States this year. What kind of numbers do you need to get on payrolls, basically, to hold the unemployment rate steady at around 4.2, 4.3? And the answer could be as low as 20 or 30,000. So how does the market react if you get a weak print, but the unemployment stays
it's making that calculation very difficult.
And how long do you need to sort of see the unemployment level steady before the market goes, actually, we can leave we can have a relatively small print. But then you take the growth narrative away. Can the US economy grow if we don't see the serious amounts of immigration? Has it only grown over the last few years because of the serious amounts of immigration, plus also, obviously, huge government spending? You take one element of that away, do you still get the growth out of the US economy?
Well, the ADP numbers yesterday suggested something similar in terms of a drop of 33,000 in terms of the private payrolls. I thought that was interesting. Does it foreshadow something scary in the payrolls number today? Unclear. They're not always related. But I thought it was interesting that instead of responding to the ADP numbers, the US bond market responded more to what was happening in the UK.
Yes, absolutely. So let's go to the UK, shall we? Because because we saw incredible moves in gilt markets yesterday. Lizzie was pointing out the last part of the last hour. Comparisons, are not perfect back to the Truss episode, of course. We're not talking about something on that scale. BMO again, Lawrence Mutkin there saying this was not a disorderly market rout as we saw a few years ago. But let's recap what we got. Gilt yields at the 10-year horizon up 16 basis points, up 19 basis points at the 30-year. So we'll be watching in 55 minutes' time to see if we're able to draw any line in the sand. It seems on the pound, what's interesting, people are saying watch euro pound instead of cable, because cable is a bit more confused by other things. But the euro gained, and the euro has not given up those gains. So we'll watch what happens with the currencies as well. But do we draw a line in the sand? Has Starmer coming out and saying, look, she's going to be Chancellor for years to come? Is that enough? Does he need to go some way to define where this $5 billion is going to come from? Or can he keep saying, I'm not going to front-run the budget, you wouldn't expect me to do that? So that seems to be where the market is thinking. And how is she going to fill the fiscal hole is something that I know Phil Aldrich has given a lot of time and thought to. We've got a great piece on the Bloomberg terminal talking about all the options there, change in Bank of England policy, wealth tax, fiscal drag, a tried and tested tool, of course.
She's really short. The UK is really short at this point in terms of government money and where it's going to come from. The number's not $5 billion. That's what they've lost this time around. I appreciate that's not what you're saying, but it could be as high as $30 billion. So where does the number come from? Where does that money come from in the UK? And which portion of the economy is capable of sustaining higher taxes at this point? Yeah,
and fiscal drag is something that has been done before, could be something they do again, but the OBR pointing out there's only so far you can go along that road before you start to disincentivise growth.
So Phil's got some great pieces, sort of elements of his piece this morning. He talks about the fact that you could stop the Bank of England's programme or change the Bank of England's QT programme. That could be one element that you could ultimately look to. There's also this kind of tax gathering element, which is basically Her Majesty's Customs and Revenue needs to do a better job of taking in money that is owed to it and figuring out a way of doing that. They've been financing that, but do they need to finance that more, i.e. give more money to make sure they gain more money? There's lots of things that the UK government can do at this point in time. The question is, does it, can it, will it pull some of those levers, and which ones does it pull?
Well, a lot of the analyst commentary in the last 24 hours, aside from the fiscal, was saying the bond market is directly reacting to Rachel Reeves being in office. Has, just from a political point of view, for a non-UK person, does that put him in a corner? If there's a question of credibility here from Keir Starmer at the end of the day, does that, and he's talking about Rachel Reeves staying for years and then needs to maybe make a change at some point down the road?
I mean, does he shuffle other people within his top team? That's an option that he would have open to him, of course. I think that we can get into a conversation. We've got a fixed income guest coming up about what message we should take away from the higher gilt yields. Because is it all about uncertainty, or is it about the specific names that were being touted as replacements, or is it just, because there's a risk, there is just risk if you change that you don't get adherence to fiscal rules, even though, Rachel Reeves might not be adhering to them in the future. We just don't know.
It's just the UK is vulnerable. The UK, if there's going to be a crisis in global bond markets, kind of feels like this could be one of the places it could start. And you wonder what the ripple effects of that could be. But the UK is vulnerable. And is the government in charge, or is the bond market in charge? And it feels increasingly likely that the bond market is in charge.
And some people have been drawing parallels between the way that the bond market was in charge yesterday and the bond market was in charge in early April or later into April, and kind of giving messages back to the Trump administration around trade and tariffs and saying that we need to make progress here. And we're keeping trade very much in focus.
OK, let's talk about trade. Vietnam, 20%. Is that the new baseline? I don't know. 40% is the number if you're Chinese, because basically the Chinese have been pushing a lot through Vietnam into the United States. That's going to be really hard to police. I'd really like to show some people some charts right now, because take a look at what is happening with the Vietnamese dong. It is a fixed currency. How many currencies this year have depreciated against the US dollar? Not many. Here is one. It is fixed and it has gone up. It is basically a currency that has depreciated against the dollar. There aren't many of those charts out there at the moment. And you wonder whether or not that is going to continue. You do look at what is happening here, and you look at a currency that potentially could be offsetting some of the changes that we're seeing as a result of the 20%. But also there's a broader question here about 20%. Is this going to be something else that we are going to be seeing other countries having to deal with? And if it's if the number is 20%, that is a big step change higher in terms of the narrative around
because
tariffs.
If Vietnam teaches us anything, 20 is higher than 10, and 10 is where they were up to this point. It's lower than 46, which is what had been touted on early April, Liberation Day. So that might tell us something about where these deals go from here, and it won't be something positive. Although I was interested to see Nike shares. They were really volatile yesterday because they make a lot of stuff in Vietnam, and lots of analysts saying this is actually quite bad. Nike can't pass all of this extra cost onto their customers, and yet the share price didn't do all that much by the close. It was up just a touch.
Perhaps because it got so beaten down by the 46% that was initially put on as well. And then the other piece of this is the enforcement mechanism of that. And you were talking about this transshipping idea in terms of products that ultimately get the Vietnamese label that ultimately come from China as well. It's unclear how many American companies subscribe to that practice. I'm sure there's plenty of them, but there is a question here of enforcement, of whether or not that actually comes about to 40% at the end of the day.
The story this morning is going to move on to chips. This is another element of the trade story. Basically, the US is loosening up on some of its chip restrictions that it's been applying to China, which again, is this an indication just how desperate the US is for rare earths, that it is prepared to give ground on chips to what it sees as being its biggest strategic rival?
This is what they agreed in Geneva, isn't it? And then again in London, and then again more recently.
Virtually on Zoom somewhere.
But I also hear noises that the US has yet to see evidence of rare earths flowing in. So it's eased up on the chip restrictions. Who's in the driving seat here of this narrative? Chinese are certainly maybe getting what they want out of this deal. We'll wait and see whether the US actually gets what it wants. We've got some great guests to chat around all of this. James Turner, BlackRock co-head of European Fundamental Fixed Income, is going to be joining us shortly. NFPs, what's happening in the UK, lots to talk about there. Abigail Watts, UBS US economist, joining us ahead of NFPs. Henry Allen, Deutsche Bank research macro strategist, joining us ahead of NFPs. Andy Sieg, we're looking forward to this conversation. Citi's head of wealth will be joining the programme a little later.
Very excited to see what he has to say, especially on kind of where the UK stands in the broader landscape of things. Is American exceptionalism over? We might find out Citi's view today. In terms of the daybook, there's plenty to digest. At 12:30 p.m. UK time, you do have an ECB monetary policy account numbers. But as we discussed, the main event today is going to be this NFP numbers, the unemployment data. Do we start to see cracks in that? The 33,000 drop that we saw in ADPs, is that a harbinger of what's to come? That data set at about 1:30 p.m. UK time. Keep an eye on that. And then 90 minutes later, US ISM services also going to be hitting the wire.
What else do you need to know? What is it, Thursday? Feels like it's been a slow week already. We've got a long way to go, but it's the end of the week today. OpenAI has agreed to rent a massive amount of computing power from Oracle as part of its Stargate initiative. Sources say the rental will total about, get this, 4.5 gigawatts of data center power. That's the electricity. That's basically enough energy to power millions of American homes. Oracle is also said to be developing multiple new data centers to meet the additional demand which is going to come from OpenAI. Barclays has revamped its investment banking leadership team in the Asia-Pacific region. Avanish Thakur, who heads up the business, says the new team will, quote, drive the next phase of ambition. Barclays has been making changes to its investment banking offerings in recent months as part of a broader push to boost returns at the bank. And Bloomberg has learned that the CEO of UniCredit, Andrea Orcel, and the German finance minister have exchanged letters over the future of Commerzbank. Sources say Orcel renewed his push for a deal that he says would create a European banking champion. Klingbeil responded by urging Orcel to direct any proposals to Commerzbank's management, i.e. send the letter somewhere else, and reiterated the government's support for the bank's independence. Here we're talking about Commerzbank. So it still feels like Orcel has business here, but not getting much response.
Might be a bit of a long game, perhaps. Yeah. We will watch and
it's already
wait
a long game.
And see. It's been long enough already. Coming up, European chips will be in focus at the start of trade today after Siemens says it received a letter notifying it of the lifting of some China restrictions. That's around that chip US story. Plus, UK politics has been spilling into markets, as we've been discussing. We'll check on the key sectors in equity markets, those that are responsive to gilt yields. We'll, of course, get an update on the gilt story in just under an hour's time. Up next, we'll be joined by James Turner, BlackRock co-head of European Fundamental Fixed Income, as we look ahead to gilt trading in 45 minutes' time. If you have any questions for our guests, please get in touch. IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
think that when you have a situation like we saw with the Truss government back in 22, then effectively that's going to put on a premium that's is quick to go on but hard to get rid of. And at a time where globally everywhere there's concerns around rising debt levels, not just in the UK but bluntly everywhere, it could be seen as a bit of a canary in the coal mine. It's had a blow up before, it's had a tantrum before, so it's potentially vulnerable to another tantrum again, isn't it?
The long shadow of Liz Truss, RBC Bluebay's Mark Dowding, speaking about the UK government bonds earlier this week before the blow-up that we saw yesterday. But it's interesting that there was a ripple effect around the world as well from the UK. Canaries, coal mines, that's maybe what the UK is right now to the global economy. The UK Prime Minister overnight telling the BBC that Rachel Reeves, his Chancellor, will stay on for many years to come. That's after, of course, the bond market sell-off yesterday over speculation about her future and a few tears. Let's figure out exactly what we are watching there for in terms of how this story is going to proceed. Valerie has more.
Well, it's all about whether this move extends, frankly, Guy, or do we stabilize around the levels we reached yesterday with those 30-year gilt yields soaring 20 basis points in yesterday's sessions. A lot of people wanting to make parallels to the Liz Truss move of 2022. So I pulled out a chart for you guys just to put it in perspective how big yesterday's move was compared to 2022. And I do have some bad news for you. Yesterday's rise in gilt yields, 20 basis point rise. If you ignore Trump tariffs, because that was something that necessarily wasn't caused by the UK government, to find a spike that similar, you do have to go all the way back to the Liz Truss episode of 2022. So a lot of parallels there, especially parallels with how the currency reacted yesterday, Guy. At one point, you had cable down 1.3% on the back of this rise. I think that tells you that the market is pricing in, yes, more government spending, but it's not the kind of government spending that's going to boost growth. Yeah,
that's the problem. It is the kind of government spending that is going to basically disappear into a black hole, and that's how the government has got to. That's the problem that the government has now got to figure out how it gets out of that. Valerie, thank you very much indeed. Let's talk more about this now. James Turner, co-head EMEA Fundamental Fixed Income at BlackRock, joining us around the table. Morning.
Morning.
Now what?
Well, it was a tumultuous day yesterday, clearly, and I think really what we've learned is that it's going to be difficult to make cost savings. As I just think we've just heard, growth is probably not going to come through, or is unlikely to come through. So really, then you're faced with, I suppose, two choices. You have the tax rises, and you have the change in fiscal rules, or potential change in fiscal rules as an option. Neither are particularly palatable. And I think we have to wait until autumn, really, to see exactly what's going to happen.
So until we get an answer to that question, gilt yields stay where they are, roughly, now?
I think we'll just see the continued volatility in the market and continued speculation. But and I think that's really why, when we're looking at the fixed income markets as a whole, it's why our preference is to actually look at corporates and the yield that you get from corporates in shorter and medium-dated bonds, because really that's where you actually find the stability. In contrast, you see actually they're very well financed, they're in a good state, they're actually where you can get your yield in a less volatile and more certain way.
So credit is a better bet just than govies right now?
In our opinion, yes. I mean, really, you have a choice where you get your yield from. Is you either have a choice where you can go and get it in the long end and take duration on government bonds, and all around the world they're a little bit more volatile. Or you can look at the corporate credit markets, and you can look at shorter dated, and you can be a little bit more sure to some extent, I think, because actually most companies, they're refinancing very easily, the markets are wide open, yields are very attractive, and so really that's where I think we find the best.
Tells us a lot about how we ended up in this place, doesn't it, where government balance sheets are stretched and corporate balance sheets are less so then, I suppose. Do we think then that the bond markets give the Prime Minister and the Chancellor time to come up with the answers as to how they fill this fiscal hole, or do bond markets demand answers more quickly than autumn?
Well, I think the response that we see over the next few days will determine that. We definitely have until autumn, and we have a summer break. And it depends a little bit what else I think goes on in the world and takes maybe attention away from it as well. But either way, I think it comes back to the point that actually, as you say, there's really been, over the last few decades, I think actually almost a transfer of debt into governments from corporates and households. And actually, when you heard Andrew Bailey talk yesterday, actually he said that he didn't think interest rates had such an effect anymore on households, because actually the household levels of debt are quite low, and it applies to corporates as well. I don't think that's a UK phenomenon. I think that's actually generally around the world. And again, comes back to this point, is actually why we find the corporate debt market and credit in particular that much more interesting.
So does that, I mean, staying out of the politics, but does that, if we're thinking about tax rises then, if that's the case, in the autumn, and where do you think that might come from, given the commitments that they've already said, the UK government has already said they won't put up certain taxes in this Parliament? We were talking a lot about fiscal drag. It's been something that's been done before.
I mean, I think they'll look at all the options, and they have time at least to think about it. But I think really we have to wait until September and see what government policy evolves by then. And things can change in the meantime.
Yeah. James, can we talk about the ripple effect that you mentioned earlier in terms of the fact that the UK may be, as Guy put it, a canary in the coal mine for what's going on in the US, but also what's going on in continental Europe as well. What is the ripple effect? If you see like yesterday, 15 basis point move in the gilt market, how does that translate to sensitivity in the French market, the German market, et cetera?
I think the thing is, everyone is on high alert at the moment. Everyone knows that we're going to go, or not everyone knows, but I think the one certainty that we've got maybe over the next few months is that we continue to have uncertainty around the globe. And it comes from geopolitical, it comes up in the surprising places. And that's, I think, why we want to stay nimble, we want to stay alert for this periods of volatility. And really what we do is we find it as an opportunity. Every time we see volatility, we think it's an opportunity. We need to look at it, assess it carefully, and then we can look at where we want to make our bets in terms of buying bonds.
What is the lazy trade in fixed income right now? And I say this in the context of the fact that to see a almost 16 basis point move when we've seen weeks of these concerns around the fiscal issues of the UK and very little reaction in the gilt market, there feels like there's an element of complacency in the bond market. How do you trade a bond market that feels complacent?
I think what you do is you almost look at the rate. So we've seen spread widening at some points. We saw that in April. We've seen the bond markets again tighten throughout the last few months. I'm talking more about the general markets across Europe. But what you need to do to position for that volatility is really make sure you have some bonds that you feel as though you're able to take advantage of that volatility when it occurs. So you might have some short-dated, high-quality credit that you can always make sure you are able to sell in any type of market, and then you can take advantage of those opportunities. And I think that that's the way really we're looking at the future, making sure that we stay nimble, but certainly not afraid to invest at the moment. We think actually the yields are very, very attractive still.
Can I just go back to the UK and just ask you a question? Val and I were kicking around this a little bit earlier on. Can the UK inflate its way out of its current debt crisis, given the fact that it has an awful lot of linkers out there that would mean that ultimately you would see the government being hemmed in? What is the structure of the UK government bond market? And does that actually also limit the government's room for manoeuvre in terms of what it does next? Because there is an argument that says you could try and go for growth. But if you go for growth, are you going to generate more inflation? If you try and inflate your way out of the problem, are you going to have a problem with the linker market? How is the bond market here set up? And in what ways does that limit room for manoeuvre further?
I mean, I think we've got a short period of time before those months to the autumn statement will pass relatively quickly. So I think actually that there's certainly a limited room for, or limited amount that the government can do at this point.
Right.
And really, I think the best laid plans are things that they can sometimes go awry. I don't think necessarily they'll be looking to inflate their way out of this. I think growth would be clearly the key way that people would want to get out of this. But then you're at the mercy of the global economy to some extent.
All right, James Turner, co-head of EMEA Fundamental Fixed Income at BlackRock, joining us around the table, walking us through how to trade these markets. The next pivot point, U.S. jobs data. We're going to dive into it with Abigail Watt, U.S. economist over at UBS Investment Bank. Stick with us. This is Bloomberg. We are getting Swiss CPI breaking across the Bloomberg terminal. The consumer price is rising on 0.2% on a month-over-month basis, 0.1% year-over-year. Coming in a little bit hot. You're seeing an immediate currency reaction this morning. Strength when it comes to the Swissy and climbing. Now, I want to bring in Valerie Teitel for a little bit more analysis here because, Val, you flagged this to us in terms of just how big of a deal this is. We know that the S&B recently cut. They are now at 0 in terms of interest rates. How dangerous is that when you have a number like this?
Well, this is a good print for the S&B. You know, we fell into deflation last month. It looks like Switzerland is out of deflation with this beat on CPI this morning, beat on year and month on month. I think there was, some worry out there. If we got a really soft print today, it could tempt speculation about an emergency S&B cut. Remember at their meeting just a few weeks ago, they only cut by 25 down to 0 bound, but there was some speculation that because of the strength of the Swiss franc this year on the back of all this dollar weakness, that perhaps they would dip their toes into negative rates. It seems like maybe that pressure is off the S&B for now as the Swiss economy seems to be in inflationary territory.
Just.
We'll
take that. But the fact that it's not negative, I think, is the most important thing here. How much tolerance... When we talk about the fact that they're not going to do this now, are we always just going to be on a hair trigger now for waiting for an emergency rate cut from the S&B into negative territory if the situation worsens? Because the Swiss seem to be at the epicenter of so much of what is happening here, the dollar trade. You look at what is happening in terms of people seeking safety. Switzerland's right at the heart of that. How quickly could things change for the Swiss? Because they have a history of changing things fast. We've seen kind of massive moves in the currency overnight. And I'm just wondering if like the UK almost feels like it's on a hair trigger now, the Swiss economy is on a hair trigger.
Well, look, if you look at the currency market, the Swissy has appreciated to levels not seen since they broke the peg back in 2015. Yeah. So we're definitely getting into territory that is unwanted by the Swiss government and by the National Bank, essentially because this will add deflationary pressure. It's kind of the same thing we're worried about when it comes to the ECB and the appreciation of the euro. Will that cause deflationary pressure into the European economy? But remember, the S&B, they only meet 4 times a year. So there is always speculation that they will, move in a non-meeting basis on the back of bad data. But this data today, I think, will shut down a lot of that speculation.
So we can move on then, Valerie, to think about US
think about
data
other things
still to come. And we have payrolls today. It's not Friday, but it's sort of a Friday-Thursday because the US
Friday feeling.
It's Friday feeling. Oh, no, but we have to be here tomorrow, so I'm not sure I can quite buy into the Friday feeling. Anyway, I'll go with Thursday feeling. That's good enough. And we're getting payrolls later. A focus on the number, of course. Jobs created, 106,000 maybe. That's the estimate. But also the unemployment rate. So much written about that, actually, because it's difficult to calculate at this point.
Exactly, because of the nuances around the immigration changes under the Trump administration. But I do think yesterday's ADP print, which was a surprise contraction, a massive miss, has made many people nervous about today's print and what we could get. I know that there isn't always correlation between what we get with ADP and NFP, but the nerves are there today. I think if the worry for the market is on a big miss, we start to reprice. We start thinking about the U.S. economy entering a recession and the fact that the Fed will be cutting sooner rather than later. If we do get a beat on the optimistic side, maybe the narrative starts to begin about economic resilience, and maybe the U.S. economy has already weathered the storm from tariffs, and there's only economic reacceleration from here. A lot to do with the Trump tax bill that I know you guys have been speaking about so far this morning. So I have a feeling that the narrative is going to swing harshly in one direction or the other after this print.
I feel like a goldfish this week because 2 days ago we were all excited about JOLTS being strong, and then yesterday we were upset about ADP being weak.
What number does the market want here?
Down
is the question. Does it want a weak number that encourages Powell to cut? Or does it want a strong number
that shows resilience? Shall we ask Abigail Watt?
Yes.
Let's do that. She joins us now. Abigail Watt, US economist at UBS Investment Bank. Abigail, good morning to you. So weigh in on what we're expecting then from the non-farm payrolls number and crucially around the unemployment rate. I was looking at some research from BMO that said 4.5% was their idea of where, or they've done a survey of investors. 4.5% seemed to come back as the consensus view as to a high enough unemployment rate that the Fed would start thinking about cutting. We're not expected to get there today, but how are you thinking about it?
Yeah, so in terms of today's report, our expectations are a little bit below consensus. We're at 100K for overall payrolls, and I think the composition is going to be relatively similar to what we've seen in recent months. We're expecting government employment to look relatively soft with just a 5k gain and then a 95k gain in private sector employment. And I think if we look at the unemployment rate, our expectations are that we start to see that rounding up to 4.3% in the print this month. I think one of the things that we're watching closely is kind of overall participation. You saw a big kind of decline in terms of the participation rate last month. We think that will normalise. We think you'll see an increase in the participation rate. So we think what you see in the household survey is a lot of volatility from month to month. And even with kind of a pickup expected in employment in that survey, we still think you'll see the unemployment rate rise. So the overall participation rate we think will increase, but we think that the composition you'll still see a shift higher in that unemployment rate.
OK, but if the unemployment rate goes up as expected to 4.3 from 4.2, does that then, steady as she goes, we go into 4th of July and nobody reassesses their assumptions around the Fed? Or could there be some detail in here that causes the market to say, oh, no, there are cracks, the Fed might cut sooner?
Yeah, so I do think the composition of the print is going to matter. So as I said, we're expecting that weakness in government. If you saw a bigger weakness in the private sector hiring, I think that's
like ADP.
Exactly. I do think that's the element where I think that could create a little bit more uncertainty and concern. I think if you saw a bigger miss, I think that would also kind of potentially kind of put a little bit more weight on the labour market. As you say, obviously we've seen this shift in tone from certain FOMC members, kind of explicitly referencing this idea that if the labour market were to weaken, that they could potentially cut sooner, putting July on the table. So, Vice Chair for Supervision Bowman and Governor Waller both referencing this. I think the question is whether you start to see a bigger shift in the committee outside of those members, and whether you start to see kind of more of a tilt towards kind of concerns over the labour market in the coming days.
Let's dive into the kind of details of the data specifically, because we're still waiting. And Jay Powell warned about this in the forum in Sintra with our very own Francine Lacqua, that they are still waiting for the data to ultimately hit at some point and to show weakness in a very big way. But we've been saying that since DOGE knocked out a lot of the kind of federal layoffs as well, and the federal jobs, and even that hasn't shown up. And it's been a couple of months yet as well. What are the odds that this data break or cracks or whatever is still further out than the summer?
Yeah, so I think if you look under the hood of the government numbers, you have seen federal hiring actually looking relatively soft, especially in periods where you would expect to see kind of stronger inflows into federal hiring. You've certainly seen kind of softness. And it's not just the DOGE layoffs. Remember, there is a hiring freeze in place in the federal government too. So what you're seeing actually at the minute is less so layoffs and more so actually attrition in the workforce. And if we look at that, the kind of job losses we've seen in the federal side of the numbers are actually a little bit above maybe where you would have thought, given typical attrition rates as well with that hiring freeze. So I think we are seeing some of that kind of the impact of kind of administration actions on federal hiring. But I think more broadly, I think we're in this period just now where it's really difficult to get a grip on a handle on the US data. I think what you've seen is a lot of volatility in a number of key prints that people would typically look to see kind of the health of the economy because of the tariff effect. So I do think you've seen the tariff effects, but it's potentially that you've seen more of that build up in anticipation for the tariffs and not necessarily the impact of the tariffs themselves being in place yet. I think that's not yet visible in the data, and I do think that that's something we'll start to see through the summer.
So that was the zoom in. Let's zoom out again. The whisper number is 96,000. The survey number consensus, according to Bloomberg, is 106,000. Is that a bad number? Even if we get to 100,000, is that still a bad number when historically in periods of excessive, like COVID, for example, or the GFC, the plus or minus was somewhere like 200,000. So is a number like 100,000, which may be considered weak right now, really just a return to normalcy when it comes to the pace of the U.S. economy?
Yeah, I think what you've seen in the labour market is a normalisation, right? You've seen a slowing in the overall economy and you've seen a slowing in the labour market data. I think the 100K print, we don't expect that to warrant a faster cutting pace from the Fed, if we do see our expectations come to fruition today. And I think that's because you are just seeing this slowing in the labour market, grinding slowly lower. I think what would become more concerning is a more significant slowing, right? I think if you saw kind of a much weaker print, say a 50K today, or you saw kind of downward revisions pulling down the moving average potentially below 100K, I think those are the signs where you're starting to see, a more worrying print and a more worrying kind of slowing in the labour market.
Can't believe we haven't talked about immigration.
We're waiting for you.
If immigration is zero, what number does the US, in terms of the headline number, need to produce if unemployment's going to be stable?
Yeah, so if we hold kind of participation rates stable, we think that the run rate for kind of payrolls to keep the unemployment rate stable would be around 100K. So I think it's as you start to see a slip below that level.
Right.
That's
I've seen it as low as 20 or 30. There's
a big range, and it depends how what you assume in terms of participation rate changes as well.
Right.
Because obviously, if you see kind of shifts in terms of participation, you see kind of more participation from other groups within the economy,
yep.
right? You could offset some of the impact of that slowing in kind of immigration.
Which number should the Fed focus on? Therefore, do we need to shift our focus to the? If we assume immigration is going to be zero, should we start focusing less on the headline rate and focus more on what the unemployment rate looks like?
So I think both will matter in their calculation, right? I think they'll be watching to see kind of what's happening in terms of payrolls and what's happening in terms of hiring. I think they'll be watching to see what's happening in terms of the unemployment rate, but they're aware of kind of the way that is calculated. They will be thinking about the potential implications for the unemployment rate. I think they'll also be watching kind of the higher frequency data, right?
Yeah.
They'll be watching the claims data, and you have seen continuing claims kind of hooking higher. You would typically see them moving higher at this point in the year, but you've seen them seasonally moving higher than they would typically move, right? So I think they'll be watching for a range of data. I don't know if they would necessarily be focusing on one specific element of the report. I think it's the totality of the report telling them, the labour market is looking weaker.
Softer.
Yeah, and we're told a lot that these labour reports really matter over the summer because it's the fact that we haven't seen too many cracks in the labour market that means that the Fed can say, we'll be patient, we're not in a hurry to do anything. The other thing we're monitoring, of course, over the summer is CPI and whether we get those tariff effects, and you were touching on this a little bit, Kriti. But when do we think that... Does that really start to show up? In the middle of this month, we get the June print, don't we? Mm-hmm. Do we start to get the impact of tariffs? Is it going to be very visible, Abigail?
So I think there's a lot of moving parts in the CPI data that mean we potentially don't even see a big increase in goods prices in the June print. And I think that's because when we look at the kind of seasonal patterns post-pandemic, the seasonal factors we think will weigh on the CPI print by around 10 basis points in the June print. So I think you'll get this kind of artificial sense almost that you're not going to see this kind of pass through. I think there's a number of reasons as well to think that the pass through could be slower. Yeah. So I mean, people often point to kind of obviously inventory building within companies, but there's also kind of methodological reasons in the CPI. You kind of sample certain goods every other month. So you don't necessarily see the kind of full pass through in 1 month, particularly given the kind of incremental change we've seen in tariffs. Yes. A number of different changes in policy kind of over the past couple of months, and kind of some of those moves will take longer, I think, to feed into the numbers.
Abigail, great to see you. Thanks for setting us up perfectly for the data, which is going to arrive at 1:30 UK time a little bit later on. The Whisper number 96, the survey number 106. Abigail Watt, US economist at UBS Investment Bank. What are we going to be doing next? Novartis' blockbuster antibody drug failing, well, one of them, in a late-stage trial. We're going to be a little bit more specific when we talk about it next. That's coming up. This is Bloomberg. Thirteen minutes to the market open. Let's talk a little bit about what is happening here and what's going on with these markets. As you can see, a little bit into equities, not a big one. We've got NFPs coming up. It is Thursday, which confuses everybody, to be honest. But we are a little better bid going into that number here in Europe. But politics front and centre on both sides of the Atlantic. Over here in the UK, it's about what the future holds for Rachel Reeves. Over in the United States, it's about the big, beautiful bill. And that's catching Kriti's eye this morning.
It is, because it's enormous, as the name suggests, or the X name suggests. I hear it's been renamed or nameless for a moment. I think it's important to talk about what's actually in it for a global audience. And this is really crucial here because it's about $4.5 trillion worth of tax cuts over the next 10 years. This was a big concern for a lot of people when we're talking about consumer confidence and consumer spending in the United States, is that would we go back to the pre-2017 era of taxes? This bill says no. It also talks about $350 billion worth of defense and immigration crackdown as well, at the expense of Medicaid payments. And this is something I'm going to dive into in a moment. They're cutting by almost $1 trillion. The car sector very much in focus. We know the drama between Elon Musk and Donald Trump showing up in this EV tax credit suspension that kicks off in September. But it's also talking about an auto loan deduction with the caveat that if you buy a car made in America, you get a bigger deduction. To me, though, I think the highlight of this that has a lot to do with the continuation of Joe Biden's policies, actually, is credits in chip investment. So it goes from 25% to 35% on that level. And that's going to be something that's really crucial and something that is a bipartisan kind of big promise from both sides to invest in manufacturing at home. But let's talk about the holdouts here, because this is not a done deal by any measure. It did pass the Senate. It is not getting the votes in the House because of these 5 people who have voted no on just the procedural vote. Now, let me walk you through it, because these are some key 5 Republicans, most of which we're talking about deficit concerns. I'm going to dive into that in a moment. But a lot of these have massive exposure to rural districts as well. So you have the conservatives talking about how much this is going to cost. But you have some of the moderates, like some of the folks listed here, who are concerned about those Medicaid payments that are getting cut, hurting some of the hospital revenues and some of the hospital operations in their communities, which brings us right back to how much this is ultimately going to cost. And I want to put this in the context of the deficit. This is what those kind of hardliner conservatives are really, really worried about, because this is a 20-year chart of where U.S. fiscal debt stands. We're at over $36 trillion. Going all the way to the left side of this chart, this is 2005, when we were at a quarter of the current debt. So in 20 years, quadrupled. And this is really crucial, because if the bill passes as it stands, we are talking about an increase of over $3 trillion on top of the existing $36 trillion. So almost $40 trillion of debt, Anna. Do the bond markets care? Right now, no. Will they in a few days?
Let's get another perspective on just that question then, and bring in our executive editor for Asia Markets, Paul Dobson. Paul, good morning to you. So Asia Markets, following this voting very late into the night, early morning in Washington around the big beautiful bill, or whatever it's called these days. Paul, is there a risk that Treasury start to care about this again before 4th of July? It doesn't seem to be what's driving Treasuries right now.
Hi, good morning, Anna. I don't think it's the driver, but I do think that it's one of the very important elements in the background of everything that people are doing right now, right? We are worried about deficits and we are worried about spending. We're worried about that in the UK gilt market. We're worried about that in Japan. We're worried about it in Australia even. We're worried about it in the US. That's why we've seen this big steepening of the yield curve, right? People are worried about the amount of supply coming into the market and how it's going to push up yields at the back end of the curve. And so while that's not the first thought that investors are reacting to on a day-by-day basis, it is there and that long-term view and informing everything that people are doing. And by the way, I think probably on the stock side as well, this is stimulative. This is good news for equities if it does go through. We're at record highs, right? And a global index, we're at record highs in a US index as well. So people are seeing this coming, assuming that it's going to go through at some point in some shape or form. And it's there in the background, even if it's not the main focus on a day-to-day kind of price swing basis.
Paul, is the trade deal with Vietnam being taken as a good thing? 20%. Are we okay with that number? Is that good enough to keep the market rolling forward on a risk basis? It's a big jump higher from where we were a year ago in terms of tariff levels, but it's a big jump lower from where we've been more recently.
Yeah, it's really interesting. I think there's a few different ways to unpack it. Feels like a better deal for the US maybe than it does for Asia, for one thing. We saw US markets continue to pick up. The fact that we got a deal is good in any case. I think that on top of that, for Vietnam, yes, it's a doubling of the tariffs from where we were, but it's also come down from the 34% that was mooted earlier on in conversations. So from that perspective, they're a little bit happier. And if you look at the way that the companies are trading there, particularly actually US companies with factories and production in Vietnam, those have all been doing pretty well. And anything that supplies them as well has been having a pretty good day. So it feels like market thinks that Vietnam can weather this storm or that can ride it out, that the pricing can be sort of absorbed either by the producers on the one side or by the US consumers on the other. So they're happy enough with that as well. And I think China is the other interesting thing. What we really want to know is 40% pass-through costs on everything going through Vietnam and onto the US. Is that going to be disruptive? Feels like the market thinks China can probably find ways to get around that as well. So all in all, people taking it as okay, we can probably ride this one out. And good that a deal was done.
Paul, 20 seconds ahead of the jobs number. Does this market want a beat or a miss?
Interesting, isn't it? We had the bad news yesterday, and that seemed to support markets on the Labour front. So it feels like people are getting more excited about the idea that the Fed is going to be able to cut quite soon. I'm surprised at how quick that's being priced into markets. If we do get a low ball number, then maybe the market continues to price that in and takes it as a positive.
All right, Bloomberg executive editor for Asia Markets, Paul Dobson, joining us this morning with his analysis. You get more from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro and get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're watching Siemens in Germany today. This linked to the news that the US is removing these restrictions on design software for the chip space, the semiconductor space. And Siemens is one of the key companies exposed to this, along with a couple of firms in the US like Synopsys and Cadence. But Siemens in Europe, probably the one that could get a boost from this. Siemens, of course, actually had a decent run over the past few years, more than doubling in value, outperforming significantly. So potentially this could actually add more gains to this stock today. So keep an eye on Siemens in Germany this morning. Then on the potential downside, we've got Novartis missing the primary endpoint in a key blockbuster trial. This was a drug that treats inflammation in blood vessels and was seen as one of their highest profile drugs. Already a blockbuster drug, but was seen to be potentially increasing the revenue if that trial was successful. Bear in mind, though, analysts pretty downbeat on this stock already. Actually, 5 sells, 15 holds, more than the buy. So potentially some of them were looking at the risks ahead of these drug trial updates. But keep an eye on that one in Switzerland. Then I've got my eye on home builders in the UK, given that sell-off we saw yesterday. News, of course, Starmer saying Reeves will stay in place. But look at that, the biggest decline in around 2 years for home builders yesterday. Watch them in London today.
Yes, Joe, I saw 8 of them on the Stock 600 were down by more than 3.5% in yesterday's session. That's real estate-related businesses. Joe Easton, thank you very much for setting us up for today's session. We'll certainly watch all of those stocks. We will certainly watch the gilt market as well. That opens up in a few minutes' time. We'll bring you the market open. This is Bloomberg.
Couple of minutes to go until the opening trade. There is a lot going on right now, and we're heading into a long weekend in the United States, which is going to kind of have an effect on the risk tolerance of this market as well. We're going to payrolls today. Still don't know what's going to be happening in the UK. Feels like we're on a hair trigger there. We're watching so many things right now that could shake this market loose. But at the moment, the momentum is still positive. Look at what is happening with risk assets. You saw a sell-off in Europe, a UK effect around the European market yesterday. But look at what the States did yesterday. Just kind of left to right, up, up, up. The market continues to push on. Risk assets continue to be bought. And that seems to be the overriding narrative at the moment. What shakes the market loose from that narrative? I don't know. Does a big print today out of the US change it? Does a weak print out of the US today change it? I don't know which way the market is going to look. It does seem as though the moment, the narrative is for positivity. Glass half full seems to still be the structure that the market is operating with.
Yep, lots of green on the screen. You're seeing it in the futures. I mean, I think you covered it, though. There is this kind of complacency. There's this return to risk assets to the point that you're seeing even DAX futures outperform this morning, which has been the outperformer of the last 6 months and higher by 0.5%. Does that all shake, though, when the gilt market opens in just a few minutes?
Yeah, it strikes me as interesting that UK futures and DAX futures look quite similar this morning, and that wasn't the case yesterday. We saw some of the real estate stocks coming under pressure in the UK market as a result of that move higher in gilt yields. It certainly happened at the 10-year, 30-year horizon. So we'll watch what happens with gilt yields and what that does to UK house builders today. Was that all yesterday's move? We will see. Siemens in focus. This is on the lifting by US regulators of chip export licenses to China. So we'll watch Siemens and others. And RyanAir having to cancel some flights, 170 flights, in fact, due to air traffic control strikes in France.
I can hear the steam coming out of Michael O'Leary's ears at the moment. The frustration with the first wave. French ATC, always an issue for him. Anyway, let's talk about the opening wave here for the market. As you can see, the FTSE 100 is up a little bit this morning. Remember, it is mechanically dispositioned to be moved by what is happening with sterling, but it doesn't seem as if that is the factor that is affecting things this morning. Looks pretty much in line with everything else. The IBEX is up by 0.2%. The FTSE is up by 0.2% as well. The DAX, wow, there must be no news in Germany this morning. It is out early this morning and up by 0.4%. The CAC is up by 0.3%. of 1%. You do wonder, actually, whether equities are the place to look this morning. There are plenty of assets that you should be focusing on. Are equities the place to be kind of focusing your attention today? I suspect the bond market, what is happening in foreign exchange, may be a bigger factor a little bit later on. But you could see, potentially you could see a big reaction in equities, particularly going into a long weekend, if we do see an outsized print either way when it comes to NFPs a little bit later on. Let's talk sectors. Let's figure out what is happening there. Kriti, over to you.
Absolutely. We are seeing a broadly green on the screen this morning when it's in the sector perspective. I'm trying to find the underperformers, and really they're all concentrated in the utility sector, which I think is fascinating. If you're thinking about a defensive trade, utilities is the outperformer, which tells you this is a risk-on market right out of the gate, at least when you look at the FTSE 100, or at least, the Stock 600, but also the FTSE 100 as well. I'm waiting for a more dramatic reaction from the last 24 hours, Anna, and I don't see it.
Well, we'll go to the gilt market for some drama, shall we? We saw big moves higher in gilt yields yesterday, up by 16 basis points on the 10-year horizon. Today, we take back some of that, unwinding around a third of yesterday's moves. We just take it in basis points, simple terms. So the 10-year yield on gilts down by 6 basis points this morning. So we are reversing some of those moves, those words from Keir Starmer saying that his Chancellor will be with him for years to come. Seems to be enough, at least, to calm the markets in the very short term, but crucially not taking us back to where we were, either on the pound against the euro or on gilt markets. So some level of nervousness, and linked to that then, we are seeing some real estate stocks gaining a little bit, but similarly not recouping all of the losses of yesterday. Some of them are down more than 3.5%. Today, the likes of British Land, Seagrow, Shaftesbury Capital up by less than 1%.
Does the market believe that Rachel Reeves is secure? Not entirely convinced, looking at the price action this morning, that there's a level of conviction in that. So maybe it's just a time thing. Do we need to wait longer? Do we need to watch and see what happens here? I don't know. It's going to be an interesting one to pay attention to, Kriti, in terms of the sensitivity the UK market has to the politics that exist here in Britain.
Yeah, absolutely. And I think this is really crucial as we talk about what some of the individual kind of factors are. Where does this get priced in from an equity perspective, as we were talking about from a bond market perspective? Because, again, coming back to the FTSE 100, I'm not seeing a ton of that reaction as well. If you look at the broader market, though, you do see some reaction, like the Siemens. That is, of course, going to be a story that's related to the trade, to the chips, and that conversation. We're going to dive into that read-through in just a moment as well. I'm seeing a little bit of underperformance from the commodity sector. Rio Tinto, NL, however you say it, is being a little bit on the back foot. But again, it feels like a light volume kind of day. It feels like a macro story to me. So let's bring in a true expert here. Henry Allen, macro strategist at Deutsche Bank Research, joining us around the table. Henry, let's pretend the market hasn't opened just yet and talk about what's going on in the UK, because I think this is fascinating that we're seeing, it doesn't feel like that much of a reaction function. What's going on here?
Well, I think the market's been really reassured by Keir Starmer's words overnight that, he said that Rachel Reeves is going to be in a position for many years to come, as was said. But I don't think the market reaction is actually to the person of Rachel Reeves or even her position. It's what she represents, because Rachel Reeves, as Chancellor, and indeed when she was Shadow Chancellor, made a big play that we are not Liz Truss. We have these very strict fiscal rules, at least in her narrative, that they were going to stick to. And what the bond market is concerned and why it sold off so aggressively wasn't because Rachel Reeves per se will lose her job. It was that the new Chancellor, whoever that might be, and we're already seeing this pressure from Labour backbenchers in the media, might ease the fiscal rules, which is in essence code for borrow more money, and then you risk the kind of Liz Truss scenarios that we saw 3 years ago, or at least edge closer to them.
Well, we've been talking throughout the show about whether this kind of UK freak out, if we will, in the gilt market yesterday is a canary in the coal mine for all the other deficit issues we see around the world. But before we get to the bond market, why is the equity market not reacting more? And I'm not just saying this to the UK drama, but also you're seeing deficit issues in France and Spain and Italy. You're seeing it in the United States, and the equity market is looking through it. What changes that?
So I would disagree slightly with that because, yes, actually yesterday the FTSE 100 did underperform the rest of the European market. And actually, if you look at the FTSE 250, which takes not the 100 biggest companies, but the 101st to the 350th biggest companies in the UK, that actually had its worst day yesterday since the Liberation Day turmoil in early April. And that's a more domestically focused index. So I personally don't entirely believe that the equity market, particularly the domestically focused stocks, are entirely looking through that. I think there is a lot of nervousness because the government have kind of boxed themselves in. They've said they won't breach these fiscal rules, but then they've also said that they won't raise a lot of the major taxes like income tax and VAT. They've proven it's very difficult to cut spending. We've had the U-turn over welfare. We've had the U-turn over the winter fuel allowance. So the market is thinking, how on earth do they get out of this? And it's not obvious which way they turn because every option seemingly is unpalatable.
Henry, so we're in an interesting place where our guest in the last hour said that some areas of corporate credit look like a safer bet, more attractive options than government yields right now. How would you look at the two and the sort of relative risks when we're talking about a period post-COVID where government debts went up and corporate balance sheets have been repaired?
So I think the risk right now on the credit side is that spreads are still very, very tight by historic standards. So
complacent.
Yeah, and I think, to be fair, with the broader kind of cross-asset moves, the S&P 500 at record highs, European equities also close to record highs, I think there is that complacency. I'd be a bit reluctant to say that spreads can go much tighter than here, given how close we are to the kind of post-global financial crisis tights. But, clearly, I think that there's a nervousness among long-end bond yields throughout the world, not just in the UK, but more broadly. We've seen that in various auctions that have gone badly. We've seen that in France. There were big jitters over their deficits last year following the elections. That still hasn't been sorted out. Obviously, Germany are now making a big push on the fiscal side. There's nervousness in Japan over their debt, and of course with the tax bill going through the US. So pretty much every G7 country has this problem. And I think it's a reflection of the fact that, countries don't need to be at the mercy of the bond market at the end of the day. The problem is, as the UK and the US both show, is neither country has run a budget surplus since the early 2000s. And if you want to spend more than you tax, that's a decision you can make, but that in and of itself is going to make you at the mercy of bond investors to some extent. And until that changes as a political choice, we're still going to be trapped in this dynamic.
Yes, and the gilt market sending quite clear signals yesterday, which no doubt will echo in Downing Street to some degree. Henry, the other thing we're preoccupied with right now is tariffs out of the US, and we are trying to get our heads around the latest news flow and what it tells us about where the tariff conversation goes. So we've had this example of Vietnam, a 20% tariff there, which is higher than where we are now, 10, but it's lower than 46, which had been talked about at the beginning of April. Are we getting closer to understanding the landing zone for these tariff conversations? We've got the UK, we've got Vietnam. Do we have a sense of what the end game will be yet?
I think we're getting a little bit closer. So, for example, the fact that even the UK still faced that 10% baseline tariff was instructive because the UK is a country that has fairly balanced trade with the United States, and it's also a US ally. So even a country like the UK couldn't get those tariffs lower than 10%. So that 10% baseline does seem to be something of a flaw. But then also you've got China, which, of course, is Trump's big target. He's attacked them for their trade surpluses. They're obviously a strategic rival. Even there, though, Trump dialed back those tariffs from a high of 145% all the way back to 30%. Clearly, that's only for 90 days, I'm conscious, but the fact he did that was indicative. So the landing zone appears to be in this kind of 10 to 30%, and Vietnam having 20% kind of seems to fit into that pattern that if even kind of a notional US ally like the UK and then a rival like China, a squash between 10 and 30%, that seems to be
It's a big range, though, isn't it? If you're a business that produces a lot in Asia and you're trying to ship it to the United States, you don't know what to assume at this point.
Yeah, assume nothing, because everything changes so fast at the moment.
Yeah.
Or does it? Equity markets, if I just looked at the equity market, I would assume that everything is great. There's so much noise in my head at the moment about all the different things that are happening. What's the UK? What's happening with the tariff story? What's happening with the rates narrative? Will Powell keep his job? Will he not keep his job? Who's the next Fed chair? There's so much going on. I look at the equity market, and if I just looked at the equity market, I would think that everything's great right now. Explain to me why we're in the scenario that we're in, with equity markets looking good and volatility as low as it is.
I think there's a couple of reasons. So one is that the macro fundamentals are still pretty robust. And actually the fact that the data, the hard data, has been so resilient since Liberation Day has meant investors have felt there isn't going to be a recession. We had that big sell-off mainly because investors started to think there would be a recession. The fact we're not getting that is very promising. The other thing that I think is keeping a cushion on things is that policy, whether that's tariffs or fiscal policy, is to some extent endogenous to the system. We kind of treat it as this exogenous variable, but actually every time that we've seen issues, for instance, the turmoil after the tariffs, the turmoil with fiscal policy, consistently policymakers have rowed back. So actually I think the market is actually acting as a constraint on policy and preventing outcomes that would lead to a bigger deterioration in those macro fundamentals. So as long as that remains the case, and policymakers kind of remain in this channel whereby they, from a market point of view, are considered sensible, then I think the all-time highs can continue.
So I can turn the television off. Don't
say that, Guy.
I know.
Nope.
I can cancel the news feed. I can do all of these things because it doesn't matter. Because I just need to look at the equity market because the equity market is correct in assuming that, all things being equal, policymakers aren't really going to upset the apple cart. Is that that's the essence of the trade right now?
I think so, because it's not in these policymakers' interests for the apple cart to be upset. At the end of the day, these are politicians who want to get re-elected. They want to be popular. Trump doesn't want a huge wave of inflation from tariffs, having seen what inflation did to lots of governments around the world who weren't re-elected.
But he's changing immigration massively. There are factors that seem to be that have yet to show. Is it just that they haven't shown up yet? The impact?
I think there is some element of that. I mean, and certainly I'm conscious the inflation experts have always said, look for the impact in the June and July CPI data. I'm conscious that's July 15th, that CPI report. But, we've had 4 downside CPI surprises in a row. So I think the market is thinking, if we can get another downside surprise, if we don't see an obvious impact from the tariffs, that keeps the door open to Fed rate cuts, and then the rally can continue. So, the fundamentals are in place. When the Fed are cutting into a soft landing historically, that's been a tremendous scenario for risk assets. That's what we're seeing right now.
I feel a lot better now.
Precisely.
So thanks, Henry.
Yeah.
Thanks for that.
Okay, Henry Allen, macro strategist at Deutsche Bank Research. Thank you very much indeed. Let's talk about what the core 6 looks like and figure out where we're going next. Joe, what do you got?
Start today, because we are seeing a little bit of positivity in that one today. We're up around 1.5% at the moment. This tied to this news overnight that the US removing this restriction on chip design software, and Siemens being one of the key firms that is actually producing this software, along with a couple in the US, which we'll have to watch in US trading as well. So a bit of a boost for that one. It's worth a few $100 million was the estimate I saw in terms of annual revenue for that unit. Then we've got these home builders in focus, as Henry was discussing a moment ago. It's all about whether or not the UK borrowing will have to go up, given what we saw yesterday. Potentially not so much about Reeves' position herself, but whether the gilt yields are going to remain elevated. And we saw a big drop down in the home builder stocks yesterday. At one point, they were down the most since 2022, so the biggest drop in a few years for those stocks. Coming up very slightly, but on a 2-day basis, still down the most in around 3 or 4 months for those stocks. But a bit of a boost, a bit of a relief today. Then over in pharmacies, we've got Redcare Pharmacy. This one outperforming in Germany on better sales. A lot of uncertainty on that one at the moment around new regulation coming in on prescription drugs in Germany. So it's had a bit of a volatile run, but doing a bit better on the sales for Redcare at the moment in Germany. Then back in the UK, we've got Watches of Switzerland. This one catching me by surprise this morning because the calls look pretty solid on this. The sales looked OK, but I've been speaking to traders in my IB and they're saying that the margins do look soft, predicting margins down 100 basis points in the year ahead. They're expecting them only to be down around 20 basis points. So that does look very soft. It's really the Rolex trade. So the only way to trade Rolexes in terms of the stock market pretty much across the world, being the only listed seller of Rolex watches. So it's an interesting stock to watch. Then in terms of the broker calls, Rio Tinto, that one downgraded. Kriti mentioned the decline in that one earlier. That is cut today at Berenberg due to weakness in iron ore prices. So they come down to hold, and Rio slipping very slightly. And then finally, Nordic Semi was an underperformer in the semiconductor space because Bank of America thinks consensus estimates are too high on a number of semiconductor stocks at the moment. Nordic Semi in particular, they go underperform on that one, and it's falling 4% in Oslo this morning.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers of the session. Joe was going into the micro there, but when you look at the broader indexes, you're not seeing a ton of action this morning. Where's the drama? Are we just used to the drama?
We're going to a long weekend. And we've got payrolls coming up.
Yeah, fair.
What do you want to do this morning? Do you want to take a big position? I don't know. I'm not sure that anybody's going to be sort of massively long risk.
Yeah, and the rollback in the gilt yield spike of yesterday is sort of gathering pace a little. We're down 6 basis points.
We recovered about half of it.
Yes, roughly, almost. So we do seem to be retracing at least yesterday's drama, if that counts as a small drama.
I think we'll take it. I'll take it. Absolutely. I think it's also another key piece is that we broke Swiss CPI earlier in the morning. We should mention that the Swissy is at session highs. And in fact, as we've kind of gone through the rest of the show, we have seen continued weakness in the euro, the pound, and the dollar against the Swissy. Speaking of currencies that perhaps aren't aren't or are depreciating against the dollar or moving against the dollar. Let's talk about some data that's hitting the wire as we speak at the moment. This coming out of Spain, the June services PMI rising to 51.9 reading. The forecast was 51. Now, this is significant, of course, because when we look at some of the Spanish data, we have seen it be in expansion territory for quite some time. Not a ton of reaction in terms of the euro, but Spain is the exception to the rule of some of the data that you've been seeing across the board in Europe. When you look at that and break it down by services, you're looking at a services number, that was a services number. The composite is coming to 52.1. The forecast was 51.2. On the surface, Anna, these are some good numbers.
Yeah, and we've been asking lots of times whether the American tourists who were such a big boost to Spanish, Italian tourism last year, whether that would continue with what we're seeing in the dollar. We'll dig into where the services boost is coming from. Coming up on the programme, Siemens says it's received notice that some US chip curb restrictions to China have been lifted by the US administration. We'll have the latest on Trump's trade deals and chip restrictions. That's next. This is Bloomberg.
Welcome back. 20 minutes into the session. We are pre-NFPs, non-farm payrolls over in the United States, and we're pre-a long weekend over in the United States as well. Probably means things are going to be quite quiet today as we work our way towards both of those two events. We are obviously watching what is happening in Washington and the big, beautiful bill and what future it has as well. So there's a lot to think about this morning. One thing we are a little bit more certain on is what is happening in the chip space. We do have some easing of restrictions when it comes to what is happening with the restrictions out of the United States into China. That's having a positive effect, as you can see, in terms of some of the chip stocks here in Europe. You've got Siemens trading a little higher, Infineon's tracking a little bit higher as well. So some positive effect coming off that. This, as the Trump administration has lifted some of the recent export license requirements for chip design software sales in China. Washington and Beijing obviously implementing a trade deal for both countries. There's an easing of restrictions on critical technology around rare earths out of China and chips into China from the United States. Mackenzie Hawkins joins us now. Mackenzie, let's just kind of talk me through why this is happening. Is this part of the deal that was recently done? And how much does it unwind what was there before?
So the U.S. in May imposed export restrictions on a range of critical technology shipments to China, not just semiconductor design software, but also jet engine parts, ethane, nuclear materials. And this was because Washington was dissatisfied with how many rare earth licenses Beijing was approving for export to U.S. companies. And we had several weeks of ratcheting up of controls leading up to these trade talks in London last month, at which the two sides agreed we will mutually lower these restrictions as long as one another allow the exports of materials that we think are really important. And so the U.S. has started to actually do that this week. They lifted restrictions imposed on electronic design automation software, which is what's used to actually design chips made by everybody from NVIDIA for AI components to simple power generation components. And also they lifted controls on ethane, a class of natural gases used in plastics production.
Talk to us about what this means for the strategy as a whole, Mackenzie, because as we are watching some of these restrictions at least curbed in the States, there's still a big, big push in terms of investing in stateside chip manufacturing. You're seeing that as the one big, beautiful bill. It's a key component of it. What does this mean for the strategy as a whole?
So the U.S. has for years been trying to limit China's ability to develop a robust domestic semiconductor industry that could allow Beijing to access advanced AI and benefit its military. We've seen several escalating restrictions on the sales of advanced chips themselves, also the tools used to manufacture them. And initially, it appeared that the restrictions on chip design software were following that same trend. But they only stayed in place for under 2 months. And this was the first time that the U.S. has sort of explicitly made export controls, which have historically been treated as a national security policy that's non-negotiable, something that's on the table in trade talks with Beijing. But Washington has drawn a clear line. They've said that the controls that preceded these earlier trade talks with China in Geneva are not on the table. Most importantly for Beijing, access to NVIDIA's most advanced AI chips.
All right, Bloomberg's Mackenzie Hawkins, we thank you so much walking us through some of the dynamics and developments around the chip trade. As Mackenzie was speaking, we got some headlines coming up from China, actually commenting on the dynamic between Vietnam and the deals coming out of the United States as well.
Yeah, absolutely. So China's saying it opposes any trade deal that infringes on China's interest. And this is relevant in the Vietnam-US context because the United States has imposed tariffs on Vietnam, of course, 20%, but also they have this transshipment tariff, which is seen as being something that will impact on China's ability to put product through other parts of Asia into the United States.
Very hard to police.
Very hard to police. And China very creative in trying to find ways to do that through other geographies, perhaps seems to be one of the read-throughs from our reporting this morning. Let's go from one thing that has captivated the markets, that is trade tariffs, to something else that's firmly in focus for us over the past day or so, and that has been at the UK gilt market. We're seeing a bit of an unwind in yesterday's move in gilts. Gilt yields are down this morning, 6, 7, 8 even basis points at the longer end of the UK gilt curve. So unwinding around a half of what we built up yesterday in terms of that gilt yield. Let's bring in Bloomberg UK Markets editor Moena Coniam, who can give us some perspective on what we're seeing here. I'll start with gilts, because we just showed what's happening with the gilt move. I mean, we're sort of unwinding half of yesterday, I suppose. So what's your takeaway, Moena, from the market's response on day two?
Well, it is unwinding. Things are looking better this morning. We've seen the 30-year yield coming back about 6 basis points. But yesterday, we ended the day down about 19. It fell a little bit more than that earlier. Sorry, up 19. And that is a really big move. And it was sparked by a lot of speculation, a lot of concerns which are based in real maths, but that have been festering there for a long time. And it really just showed how fragile the market's perspective of the UK economy is. Yeah. That we saw this in January as well, when there was very little concrete information, but sort of got itself into this frenzy. And that's quite worrying in itself. Now, things look better this morning. Obviously, Keir Starmer has come out and really fully backed his Chancellor, Rachel Reeves. But the question remains as to what was going on in the first place. And the market really didn't like that question of uncertainty at all.
So what are we doing now? Are we just reading tea leaves down in Westminster, trying to understand what is going on? How do we do that? What am I watching for in terms of my understanding as to whether or not this support around Rachel Reeves is real?
Well, we have to see what happens today. I think, Keir Starmer did make it quite clear in his interviews late yesterday, and I believe there's been more this morning, saying that she's going to be in that job for a long time. Of course, that's something that somebody has to say, and you can't ever know what's going to happen. I think what the rest of the Labour Party does in terms of, behind the scenes, the discussions that are going on will, of course, bear a huge influence, what comes out, what gets leaked to the press, and really whether we hear a bit more about what really was going on yesterday.
That'd be nice.
And then we're just looking towards the budget.
Yeah.
I mean, that's when actually all of this will come to fruition in terms of what options does the Chancellor have. Her fiscal headroom is incredibly tight. The U-turn on the welfare bill has not helped her position in terms of actually making the sums add up, and the market knows that. But, she has stuck to her fiscal rules. In the past, she said she doesn't want to raise taxes. There aren't very many options, and we'll have to see which way things go.
Bloomberg's Moena Coniam walking us through some of the budget restrictions in the UK. In the meantime, as she was speaking, we did get a headline crossing the Bloomberg terminal. Trump tax bill clearing the House procedural vote. Looks like a green light when it comes to the actual bill itself. We will keep you posted as we get those updates. Coming up, an exclusive conversation with the head of wealth over at Citi. Stick with us. This is Bloomberg. We do have some headlines crossing the Bloomberg terminal at the moment. The Trump tax bill crossing a procedural vote. Now, we had started this program about 90 minutes ago with 5 naysayers, 5 people who said that we are not going to move forward with this procedural vote at all. It looks like now that we have gotten there, we are actually seeing potentially a green light for the one big, beautiful bill to actually cross. And I think this is very significant because the concerns here was that it actually increases the deficit by something like $3.3 trillion on top of a $36 trillion price tag we already have. So lots going on there. We're going to keep you apprised of all the developments out of Washington, D.C. as we get them. You can see a late night for some of the congressmen over at Capitol Hill. Not much market reaction off the back of that, though, but it is something that is talking a lot about in terms of where the U.S. stands, how the rest of the world is viewing the United States right now. I think we have the perfect guy to have that conversation with. Joining us for an exclusive this morning is Citi's head of wealth, Andy Sieg, who has come on a whirlwind tour, coming to London, just meeting a lot of clients here in Europe. But I've got to ask you, how are the clients here in Europe viewing America right now?
Well, I mean, I think they see the strength of the leading U.S. companies, of course. They've got an eye on the deficit topic that we talked about in the medium and longer term. I think the tax bill itself is making its way through Congress basically as expected, and on the margin is stimulative. But, you know, you can't discount the U.S. economy. It's obviously the force in the global economy, the level of talent, innovation, capital in the U.S. economy is unmatched around the world. And while you know, this has been a roller coaster ride in the first half. Investors come back to understanding that there are companies in the U.S. that just aren't matched by their peer set around the world, and they're investing behind them.
There's a big question. There has been a big question, especially from a lot of ECB central bankers lately, who've been talking about this idea that, OK, maybe the U.S.'s turn is over. This kind of structural reallocation is here to stick because Europe has some new fundamental growth drivers when it comes to Germany, when it comes to perhaps the hope of a little bit of deregulation. Are you seeing that? Are you seeing in the clients you're speaking to some of the perhaps warmth around investing in Europe?
Well, I mean, I think we are seeing that. I don't think we should be surprised. We came into the year with U.S. equity markets as an unprecedented share of global markets, and obviously trees don't grow to the sky. And so to see that trend tail off is not a surprise. We do see more interest in the U.K. and in U.K. investors. Actually, in the first half, our business in the private bank, the investments business grew most rapidly here in Europe in the first half, so it's been a very active time with clients. You know, what we're hearing in corporate boardrooms is very upbeat. We see discussions that we see our M&A pipeline and M&A dialogue very strong across the investment bank. My colleague Viz Raghavan and team are super busy here in London specifically and across Europe. And so I do think this is a dynamic time in Europe. And, you know, and on balance, as the proportion of U.S. exposure in client portfolios has reached highs, you know, we do see incremental dollars being invested in Europe.
Do you see a difference? Good morning, by the way.
Sure. Good morning.
Do you see a difference in the approach being taken by U.S. clients versus rest of the world clients?
Very much.
Okay.
Yeah, very much.
Just explain it a bit more.
Well, there's a tremendous home bias among U.S. investors.
Yep.
I mean, we've been talking to U.S. investors about being more globally exposed for my whole career, almost 35 years, and still U.S. exposure is pretty limited. When we leave the U.S., everybody is a global investor outside the U.S.
Yep.
And so the dialogue that we have is much more about, you know, global asset allocations, the conversation we were just having around, hey, where do you go at the margin? It comes up very rarely in the U.S., honestly.
Okay. So how do you build a business for that? That increasingly, is it increasing differing approach? How do you build Citi Wealth to take account of both of those two pools of investors that feel like they have very different objectives in terms of what they may be looking
Well,
for?
I mean, hey, to a certain extent, Citi was built for this. Obviously, our headquarters is in the U.S. We're deepest, you know, in the U.S. and in New York. But this is the world's most global bank. And so the fact that we have, you know, the dynamism and the insight that comes from being a U.S. bank, but we've got truly global DNA is what our clients are looking for.
So you are set up for the world that you feel we're going towards. You don't need to change anything, is it?
Very much. I mean, you think about Citi's global network, you know, to the extent that volatility is rising, that some of the questions that we've been talking about are on the minds of investors. How does geopolitics and some of the rebalancing of global exposures, how does that come into bear with portfolios? Citi's the place to go to have that conversation.
And can I ask you a bit more about what you said there about the UK? You say you're seeing a lot of interest in the UK. Unpack that a little. Is that interest in UK assets, or is that from wealthy people in the UK interested in talking to you? What's the UK driver?
Well, I mean, first of all, the UK is the hub of our business across the region. We just had 200 private bankers and investment counselors here in the UK for our annual get-together of that team. This is the logical place to do it. Our business is growing strongly in the UK. Obviously, policy changes in the UK and across Europe are top of mind for clients, and we see topics like the non-dom discussion very much on the mind of clients, and they look to Citi to have particular insight there. We also see clients around the world who see the UK as a very attractive place, you know, to be investing on the increment. I mean, I recently had a conversation with a client in Hong Kong who has moved more assets to the UK for a very simple reason. You know, property rights have been respected in the UK for 1,000 years, and that stands out globally. And so that's something that's very fundamental, but easy to forget.
OK, yeah, that's really interesting, that sort of longer view on certainly one UK asset in particular around property. But we do hear a lot about non-doms leaving or the wealthy feeling more mobile and perhaps incentivised to leave the UK by policy changes. On the other hand, some of those, the wealthy want to go to the Middle East, and then you get flare-ups in violence in the Middle East, and I wonder how that factors into conversations. So what do those conversations look like?
You know, as you would expect, incredibly unique to each client. You know, there are clients who are anchored here in the UK, and almost regardless of tax regimes, they're going to be here in the UK. This is their lifestyle. There are others who may have global businesses. They're here in the UK, and they're worried about topics like inheritance taxes, and is it going to push them to a position where they might have to make a decision about their holdings in a company, which is really not consistent with what their next generation, you know, would like to see in terms of bringing that company forward. We see for every conversation we have around UK-based clients that are thinking about, you know, is this the time and moment that I might want to relocate? We see other clients who are thinking, hey, the UK, as I said earlier, may be a very attractive place. You know, they're looking at the U.S. and changes in the U.S. and thinking maybe the UK is the place where my kids might want to go to college, where we might want to spend more time. And so it's a two-way trade in terms of clients in and out of the UK.
Andy, let's talk a little bit about how Citi specifically is approaching this rather than the macroeconomic environment. We should remind our global audience, you joined Citigroup, and it's about September of 2023, with a pretty big project in terms of turning the bank around, and specifically wealth, where we know Jane Fraser says a lot of the gains are about to come from. The next leg of growth for Citi is about to come from. What's been the hardest part of that job, of that restructuring? Well,
and, I mean, as you said, Jane has been leading here a very broad-based restructuring of the company. I only got here 18 months ago. This has been going on for a number of years. Citi is on the move. I mean, this is a bank with tremendous heritage and unmatched global platform, and today has a strength and momentum behind the company that we haven't seen in decades. You know, coming into the wealth business, in many ways, my job was, how do we take an extraordinary set of ingredients and turn it into the #1 wealth franchise in the world? And those ingredients are the brand, a client franchise around the world, talent and platforms to be extremely flexible and serve clients in all jurisdictions. You know, but the business had been underperforming over the last 7 quarters. Revenue is now rising, expenses are coming down, returns are rising. You know, we haven't reached our goal in terms of being #1 in wealth management in the world, but we've got one of the fastest growing wealth businesses around the world, and we do things for clients that stand out.
Jim Farley over at Ford overnight talks about the fact that he thinks half of all white-collar jobs at the business are going to disappear as a result of AI. What's the number going to be like at Citi? What's the number going to be like at Citi Wealth? How does the wealth business take this technology, adapt it, use it into a business that is quite extremely client-focused and the relationship matters? How different is the AI story at Citi versus, say, a Ford? And how are you thinking about it? How big a change is going to be? Is it going to be Farley-like in terms of the kind of shift that we're potentially going to see at the way you operate the business?
It's somewhat of a different story than a manufacturing company like Ford. I mean, we don't expect the person-to-person interactions that happen between our bankers and advisors and clients to become fully automated anytime soon. AI is an extraordinarily powerful tool for this business. It's going to reshape our workforce. What we see happening here, though, is to take many manual tasks in the middle and the back office, to automate those and give us the ability to add more resources to the front end of our business and have more advisors, more bankers, more investment counselors in front of clients. So I think
hire more at the front end and less at the back.
Correct. I think employment levels are going to be relatively constant in the wealth business, but I think we're going to see that balance between how many people are in front of clients versus how many are behind the scenes shift in terms of giving us more bandwidth in front of our clients. Again, that's a terrific story in terms of growth and efficiency, returns for shareholders, and just how active and present we are in markets. I also think when you look at the last 30 years, the story in wealth management has been a very powerful one for clients. Rising quality and lowered costs. AI is going to continue and propel that story forward. We're going to be more proactive with clients, more consistent advice to clients, so we're going to be able to deliver it more economically. So I think this is a powerful catapult forward for wealth management.
Yeah, and Andy, so then that sounds like productivity gains, and how quickly do we get to those? What is the sort of delivery time on all this investment that everyone is doing in tech, in the wealth management sector?
I mean, I think to a certain extent the risk is that we're underestimating how quickly this is going to be upon us. I mean, we all see how we're living our lives today, how many incremental searches we're doing on Perplexity or ChatGPT versus Google, for example, and you see it in the data, we feel it in our lives. You know, what we see through partnerships with companies like Google and Palantir, we're seeing the ability to solve challenges we've had operationally in our business in a couple of quarters that people thought were going to take 5 or 10 years to solve. And to solve those problems, in some cases, at 1/5 or 1/10 of the cost that we expected. So that's very powerful, and I think it augurs for change coming more rapidly than we expected.
Andy, a final question to you, and I want to go back to where we started on this conversation, which is potential tax code changes. And this is, of course, something that directly affects the wealthy, directly affects the clients you're speaking to. There are potential tax cuts if this bill goes through for the United States, potential tax hikes coming down in the UK. Again, big potentials. We don't know what those look like. Are you seeing that divergence actively affect people's allocations, where people want to live, how people are thinking about the U.S. versus the rest of the world?
I mean, I think in the U.S., you know, for all the headlines and all the news, including this morning out of the U.S., this is unfolding basically as expected. Most current policy rolling forward, some incremental tax cuts and tax relief that'll benefit consumers broadly. Maybe the most consequential, you know, medium and long-term story coming out of the tax bill is the expensing of R&D and capital investments by companies, which we think, you know, over time is going to drive investment in U.S. businesses. You know, so this is, I would say this is a very consistent policy regime in the U.S. That's to say, we still have, you know, we've got a medium and long-term deficit problem, which is out there and it's not being addressed. But, you know, I think markets are going to view today and over the next couple of weeks as a relatively stimulative.
Are wealth clients sensitive to that, to the deficit concern? Does that even affect that cohort?
No, I mean, it's an increasing topic of communication or discussion among our clients as it is, you know, in the broader marketplace. It's not driving investment decisions right now, you know, by our clients, and it's not a dominant discussion. We had many client conversations this week in London. I would say 75% of the conversation is AI. What's it mean for my company? What's it mean for my workforce? How quickly am I going to have to adapt to this? And how do I invest in a very volatile, uncertain, quickly changing, even chaotic marketplace? And our message is a simple one. Asset allocation matters today more than perhaps ever. And so you've got to be very disciplined and understand your asset allocation, and you've got to be watching data and watching markets extremely closely, which is why we think for wealth management, this is a time when advice is going to be prized by clients.
And watching Bloomberg Television. Andy.
Very much.
Great to see you. Thanks
Thank
for
you.
stopping by to see us. We really appreciate it. Come back anytime.
Thank you.
Very nice to see you here in London. Andy C, Citi's head of wealth. Coming up, we're going to be back and focusing more on what is happening here in the UK. The UK Prime Minister Keir Starmer belatedly backing his Chancellor after a tearful appearance in Parliament, sparking something of a sell-off yesterday in the gilt market. We'll have more details on that story next. This is Bloomberg. 47 minutes into the equity market session, you are looking at a broad bid, not a convincing bid, but at least a broad bid across Europe this morning as we await a long weekend in the United States. We await the passage of the big, beautiful bill. We await what happens next with the non-farm payroll numbers. There's a lot of things we're waiting for. So I think we're just largely sitting on our hands this morning, enjoying maybe a nice coffee. Talking of which, let's talk about Italy and the data that is out this morning. 52.1 is the services PMI number for the month of June. That is down quite sharply, I would argue, from 53.2, the prior number, but is slightly also worse than the survey number. So things may be softening up a little bit, but still positive in Europe, which seems to be maybe the narrative that we continue to watch for at the moment. Decent growth, OK growth relative to expectations around Europe. No real surprises.
No, we had a few surprises for the gilt market yesterday, didn't we? We're winding some of those back. Let's bring you up to date with what we've got. So Keir Starmer, the British Prime Minister, has been out making comments. Well, last night backing his Chancellor belatedly, but this morning he's out on the wires talking to a radio channel in the UK, saying that the UK government is committed to fiscal rules and economic stability. This after gilts have been making up some of the ground today after UK Prime Minister told the BBC that Rachel Reeves will stay on as Chancellor for many years to come, with the words he used overnight when speaking to the BBC. This after her tearful appearance in Parliament sparked a bond market sell-off yesterday over speculation about her future.
With cutting regulation, planning and infrastructure is pounding forward, building 1.5 million homes, the biggest investment in social and affordable housing, and of course, Mr. Speaker, the 3 trade deals. Remember the ones that they couldn't get, including the US trade deal. On Monday, those tariffs came down. That secured the jobs at JLR. That's who we care about on this side of the House.
How awful for the Chancellor that he couldn't confirm that she would stay in place.
So, Bloomberg's managing editor Adam Blemford and Valerie Teitel are back with us around the desk to talk about the UK. Adam, good morning. So, what's the assessment this morning of what we're waiting to hear on the UK side of things, and how safe the Chancellor's position is?
Well, good morning. We heard there, you heard from the House of Commons yesterday, Keir Starmer not giving that backing to Rachel Reeves, but then things progressed as ever in UK politics very quickly, and by the end of the day last night, Starmer was out talking to the BBC, giving a lengthy interview in which he was really effusive about their partnership, talking about them being in lockstep and giving a really seemed like a cast iron guarantee that the Chancellor would be in position for a very long time. I think he said past the next election. He thinks along the lines of we work together, we think together, those sort of things. So he's really tethered the two of them together this morning. That, I think, has helped bring back those gilt yields and calm things a little bit. But the missing piece of this, of course, is that we haven't heard from Rachel Reeves at all since then. She wasn't up at the dispatch box yesterday. She was observing and obviously upset, and we haven't heard a reason from her as to why this was, and Starmer diplomatically and of course very politely refused to go into any further detail.
Yeah, really interesting. In that interview he gave late last night, then Guy, he was saying, no, this is a team that really is working together, unlike other teams that we've known in the past where the Chancellor and the Prime Minister haven't always. I won't name any names, but obviously referencing some Labour Party history there, it would seem.
It feels like he was told to say those things by the gilt market, effectively. Is that the narrative? Do you think Rachel Reeves would be still in position if the gilt market hadn't done what it did yesterday? How sensitive is this government in the long shadow of Liz Truss to what happens in bond markets?
Well, clearly UK assets are vulnerable in the shadow of Liz Truss. If you cast your mind back, we had that slightly incredible period where it takes a lot to remove a Chancellor, but for a period of a year or so, we went through a basket full of them very, very quickly.
Is that the collective noun?
The collective noun for
there are others, I assure you.
Basket full of Chancellors, like an inflation basket. But the Reeves and Starmer have been, until now, really close together. You've not been able to put anything between them. She's, of course, been trying to push through these spending cuts in order to try and improve the country's fiscal position. She's got all these factors weighing on her freedom to raise money. How is economic growth doing? Not as well as they hoped. Fiscal rules that restrain borrowing, and of course, then unable to get the Labour Party backbenchers to approve £5 billion in welfare benefit cuts. So she's in a bit of a bind. That's a difficult position professionally and politically for someone to be in, but we remain in the dark as to whether that was the cause of what they saw yesterday. But markets were clearly unnerved. It didn't take much, as many analysts said, indeed. Whatever the underlying reason, they were a bit becalmed before that happened, but it didn't take much to upset markets in that context.
Well, Valerie Teitel is also around the table. Val, dive in here, because the bond market reaction was really interesting. What does it respond to now? In the last 24 hours, all the analyst commentary has said this is about how long Rachel Reeves stays in that seat. Now what? Now what do they respond to?
Well, I think the whole worry yesterday was maybe the market overreacting, saying, Starmer might throw out the entire framework of his economic policy and start over again. And I think that's what the bond market was really worried about. Any change in the Chancellor or any change in direction, I think the market just assumes the fiscal slippage would happen, the fiscal rules would slip, there would be more government borrowing needed, and that's what was priced in yesterday. And I guess since we've gotten just words about stability since then, that's given a bit of reprieve to the bond market. We now retraced about half of yesterday's move in the 30-year gilt yield. So we're up still around 10 basis points over 2 sessions.
And we did see this spill into other European bond markets. We saw French yields, for example, up by the close, 10-year, I think, up 7-8 basis points. It's built into currency markets as well. The pound was weaker yesterday. It was weaker against the dollar, but that's confused by other factors. The euro really benefited and, in fact, hasn't really unwound the gains it made yesterday against the pound.
Yeah, when you're looking at Euro GBP, it does look pretty stable. But, I mean, the move in cable yesterday was pretty disastrous. 1.3% move to the downside off the back of the rise in gilt yields. I mean, that's just the Liz Truss combination all over again. And in fact, if you look at that rise in gilt yields, we really haven't seen something like that since the Trump tariffs were announced. And if you exclude that, because that was factors outside of the UK government's fault, you really do have to go all the way back to the Liz Truss
very different magnitude.
See that kind of, it's very different magnitude, but on a daily basis, a 20 basis point rise in the back end is something that is very uncommon.
Lots to watch when it comes to the pound and where these UK story goes next. Bloomberg Managing Editor Adam Blenford walking us through some of those politics. We thank you so much. Val, I'm going to hold on to you because there's plenty to go through when it comes to what's going on latest the agenda. We are counting down the hours to the U.S. jobs report. That coming up at about 1:30 p.m. UK time, which is largely expected to have some sort of effect on the currency market, perhaps on the other end of that currency pair of cable. So, Val, hop in here. 106,000, that came out weird. 106,000 is a survey number. 96,000 is a whisper number. I'm stealing Guy Johnson's question. Do we want to beat or a miss?
Well, it depends on if you're long or short the dollar. I would say that. But I keep reloading my eco screen to see if this survey continues to track lower. It's tracked lower all week.
All week, yeah.
It started out at 119. And then after that big ADP miss, after the worries about what that private payroll data showed, where it was a massive miss to the downside, showing a contraction in jobs, we've seen that non-farm payroll estimate continue to stick down to 106K. But to your point, whether do we want a beat or a miss, I think it really depends on what your outlook for the U.S. dollar is. If you think, or if you're short U.S. dollars, if you want the dollar weakness to continue, a big miss to the downside would do that, as the market would start to price in sooner rather than later Fed cuts. Maybe that July pricing starts to go up.
Is it sub 100? Is it 70? Where does the market think Powell's got to cut rates right now?
I think something south of 70K would change the pricing on July. Now, we still do have a CPI print. I know you mentioned that before on the 15th of the month. So there's still more evidence before the Fed convenes their meeting on whether they do a rate change at that. But I do think 70K seems to be the kind of line as to which whether we price in more probability of a July cut.
And it'll be interesting to see whether the market responds to the job creation number, the unemployment number, all of that in focus then in terms of thinking about that Fed reaction function. Thank you very much to Valerie Teitel. So this data comes early. It's not Friday, everybody. It is Thursday. I'm going with the idea that we've got 2 Fridays this week. That feels like a good place to be.
I like the idea of 2 Fridays.
There we are. So we're going with 2 Fridays, but today's is Thursday, the 3rd of July. That's it for the opening trade. We have built back some of the ground lost on UK gilts yesterday. Stocks in Europe are up. The pulse is up next. This is Bluebay.